Right now, without realizing it, you may have structured 40 to 60% of your portfolio to fail. What follows is a precise, field-tested framework, 3 rules used by wealth strategist James Harrington that transforms $100,000 from a number on a screen into permanent growing income that arrives every single month, regardless of what the market does. Most people believe that if their account balance climbs, they are getting richer. They chase what is hot: tech stocks, crypto, whatever financial television is screaming about this week. They confuse motion with progress and a rising tide with swimming ability. Meanwhile, inflation quietly erodes purchasing power at 4, 5, or 6% a year. A typical $100,000 position in an S&P 500 index fund looks solid until you run the numbers honestly. If you needed to withdraw 5% annually for income, 2 major crashes in a decade could reduce that balance to $60,000 or less. The growth narrative cost you 40% of your principal. As James Harrington states plainly, a portfolio that generates no income is nothing more than a collection of lottery tickets. The real villain is not market volatility. It is the conventional wisdom that says buy and hold with no cash flow strategy, amplified by a financial services industry that profits from your trades rather than your success. You have been sold a dream of future wealth while your present income runs dry. Every year inside that cycle is another year of compounding working against you. When was the last time your portfolio paid enough to cover a single month's bills? If you cannot answer with a specific dollar figure, you do not have an income portfolio. You have a speculation account. I never want to be forced to sell anything, ever. If I need income, I want it to show up in cash, without touching principal. James Harrington, Rule 01. The 80-20 income split. Take your $100,000 and divide it into 2 completely separate buckets. 80%, $80,000, goes into what Harrington calls sleep well at night investments. High-quality, dividend-paying stocks and fixed income from companies with 20 or more years of consecutive payments. Procter Gamble, Johnson & Johnson, Coca-Cola. Boring companies that move product whether the economy is expanding or contracting. The remaining 20%, $20,000, goes into growth, technology stocks, emerging markets, or anything with higher risk and higher upside. The cardinal rule: the growth bucket never funds income. You never raid one for the other. They are separate in your mind and separate in your brokerage account. This structure is not about returns. It is about protecting you from yourself. The greatest destroyer of permanent income is the panic sell, dumping quality positions at the bottom of a crash, locking in losses, and permanently ending the compounding that would have made you wealthy. The 80-20 split removes the temptation. Your income bucket is never on the table. Write the allocation down, sign it, and date it before you buy a single share. Income bucket, 80%. $80,000. Foundation holdings, rung 1, $40,000. Growth payers, rung 2, $24,000. High conviction specialists, rung 3, $16,000. Growth bucket, 20%, $20,000. Rule arrow 2. The dividend growth ladder. You are not simply buying dividend stocks. You are constructing a ladder of rising income in which each rung carries a different yield and a different growth trajectory. Together, they produce cash flow that accelerates faster than inflation over time, without selling a single share to receive it. Rung 1 is your foundation. Allocate $40,000 across 5 to 8 ultra-stable companies: Coca-Cola, Procter & Gamble, Johnson & Johnson, Lowe's, McDonald's, that have raised dividends for 50 or 60 consecutive years. Their current yields of 2.5% to 3% are not exciting, and that is precisely the point. They will not cut. Rung 2 takes $24,000 into growth payers: Microsoft, Apple, United Health Group, Caterpillar. These companies yield 3.5% to 4.5% today and raise that dividend 8% to 12% annually. Rung 3 deploys the remaining $16,000 into high-conviction specialists, a RAT such as Realty Income paying monthly, a pipeline company like Enbridge at 6%, or a telecom like Verizon. Higher income, more volatility, smallest allocation. James Harrington does not chase yield. He chases dividend growth. A stock yielding 3% that raises its dividend 10% every year will, after a decade, be yielding 6 or 7% on your original cost, while a stock yielding 8% and never raising it stays exactly where it started. The latter captures both income today and compounding growth of that income over time. Check the payout ratio before you buy. Any company paying out more than 80% of earnings as dividends has no margin for error. 1 weak quarter, and the dividend disappears. Rule 03. The yield on cost. Mentality. Yield on cost is the annual dividend you receive today divided by what you originally paid for the stock, not its current market price, but your cost. It is the single most important number in permanent income investing, and almost no one tracks it. Consider this example. You bought Procter Gamble 10 years ago at $60 per share. The dividend at the time was roughly $2 annually, about 3.3% on your cost. Today, the stock trades near $150 and the dividend has grown to $3.50. The current yield on today's price is 2.3%, which looks unremarkable. But your yield on cost is $3.50 divided by $60, nearly 6% on your original investment, growing every single year the company raises its payout. You have never sold, never triggered capital gains, never tried to time a re-entry. You simply collected growing checks. I do not look at stock prices. I look at dividend checks. The price is just the ticket to the show. The dividend is the show. James Harrington. Applied to your $100,000 portfolio, the compounding arc looks like this. Year annual income, approx. Year 1, $3,000. Year 5, $4,200. Year 10, $6,500. Year 20, $12,000. Plus, that $12,000 arrives whether the market is up 30% or down 30%, whether you are working or retired. It is permanent income. The mistake most people make is looking at year 1 yield, deciding it is not enough, and selling to chase something higher, losing every future year of compounding in the process. Stop measuring your portfolio by its price. Measure it by its dividend deposits. Track yield on cost for every position. Watch it grow. That is your scoreboard. The complete deployment plan. Open your brokerage account, preferably an IRA where dividends compound tax-deferred, and deposit your $100,000. Commit your allocation in writing before touching a single ticker. Within the $80,000 income bucket, equal weight 5 to 8 foundation holdings from the Dividend Kings list, then add 4 to 6 growth payers, then 3 to 4 high conviction specialists as outlined above. Put the $20,000 growth bucket into a low-cost S&P 500 index fund or NASDAQ ETF and review it once a year. Enable automatic dividend reinvestment for now. When you need income, switch dividends to cash and let them deposit directly into your bank account. That is the full system. Every day that $100,000 sits in cash is a day it actively loses purchasing power. Every day it sits in a pure growth fund with no income strategy is another day you are building yield on cost for someone else's future, not your own. If the market drops after you buy, good. It means you acquire more shares of quality companies at lower prices, locking in higher yields on cost for the next 20 years. The people who will be financially free 2 decades from now are not the ones who timed things perfectly. They are the ones who started today, while everyone else waited for the ideal moment that never comes. You now have the same 3 rules James Harrington has used for decades: the 80-20 income split, the dividend growth ladder, the yield on cost mentality. The only variable left is whether you act on them.